All right, today we're jumping into a really fundamental tool that every trader should know about, the fixed distance stop loss. It's a super simple way to manage your risk, but, and this is the key, that simplicity is a double-edged sword. It's both its best feature and its biggest flaw. So, let's get into it.
So, let's start with a question that every single trader has to face. How do you, actually manage your risk with discipline, with consistency, especially when the market's going crazy and your emotions are running high? It's a huge challenge, right? Well, the fixed distance stop loss gives us one potential, very straightforward answer to that question.
Okay, so let's break down what this strategy is all about. At its heart, it really boils down to one single, super simple idea, and that's the fixed distance principle.
So here it is, plain and simple. A fixed distance stop loss is just a method where you place your stop loss at a specific, predetermined distance from where you enter the trade. That's it. It's not about adapting to how wild the market is or looking at chart patterns. Nope. This one is totally rigid. You decide on a distance, whether it's in points or percentage, whatever, and you stick to it. The key is, you make that rule before you even get into the trade, and you do not change it.
Yeah, you can almost think of this fixed distance as your anchor in a stormy sea. It doesn't shift and sway with the market's every move. Its only job is to lock in your risk at a level you decided on beforehand. And that simplicity? That's what defines this entire method. And as you're going to see, that's both a good thing and a bad thing.
Okay, so the theory sounds simple enough, right? But what does this actually look like when you're in the hot seat about to place a trade? Let's walk through how it works in the real world. Honestly, it's as simple as 1, 2, 3. Step 1, you enter your trade. Step 2, you figure out that fixed distance based on your rule. And step 3, you immediately set that stop loss order. The beauty of it is that there's no hemming and hawing, no second-guessing yourself when the pressure is on. So let's get really specific. In the world of Forex, for example, we often measure distance in pips. So your rule could be dead simple. Something like, no matter what, on this currency pair, my stop loss is always going to be 50 pips away from my entry price. See, it's just a clean, non-negotiable number. It takes all that what-if stuff right out of the equation.
Now, another way to do this, instead of a set number of pips, you could use a fixed percentage. For example, a really common rule of thumb is to never risk more than, say, 1 or 2% of your entire account on a single trade. In this case, the distance is still fixed, but it's fixed in terms of risk. This way, your potential dollar loss stays consistent even if your trade size changes.
And this is where we need to pause. We've established that this method is simple, it's disciplined, it's easy to follow. But here's the million-dollar question. Does simple always mean effective? Is this really the best tool for the job?
Well, to answer that, we really have to look at the pros and cons. I mean, no trading strategy is perfect, right? And this one in particular has some really clear advantages and some pretty major disadvantages. And this really gets to the heart of it. The trade-off is huge. On the pro side, its biggest win is discipline. It forces you to be consistent, and it gets your emotions out of the driver's seat. But the cons side? Well, it's a big one. This method is completely blind to what the market is actually doing. It doesn't know or care about important things like support and resistance levels. All it cares about is that number you picked.
In fact, our source material sums it up perfectly. It says that while the method is simple and ensures consistency, it's just less effective than strategies that are based on market structure. Think about it. You could have your 50-pip stop loss get hit, only to watch the price immediately bounce off a major support level that was just a few pips further away. A smarter, more dynamic strategy would have seen that level and planned for it.
So, after all that, what's the verdict? Where does this method actually fit in? Let's try to put a final pin in it and figure out its real role in a trader's arsenal.
Honestly, this is the best way to think about it. The fixed distance stop loss is like training wheels. It's an absolutely fantastic tool for building that muscle memory for discipline and consistent risk management. It's crucial when you're starting out. But once you've got your balance, you're probably going to want to take those training wheels off and start using methods that can actually adapt to the bumps and turns in the road. So yeah, it's a tool for discipline, but it's not a tool for optimization.
And that really leaves us with one final big question to think about. When does simplicity become the enemy of effectiveness? It's so easy to fall in love with simple, clean rules. But we have to be so careful that in our search for simplicity, we aren't just ignoring what the market is screaming at us. Finding that balance, that sweet spot between a disciplined system and real market awareness, that's what the journey is all about. It's something to think about for your own trading.